Hello friends, Tim here from Inside Hawk, and today we're going to be looking at account categorization. Now this can be a very important process if you want your business's books to be in order. Also, it can slightly differ from one platform to another, so today we'll be covering the Inside Hawk categorization in particular. So first, we'll review the general theory that we covered in our accounting principles video. Then we'll break down the accounting equation into smaller parts. We'll then introduce account categories that are related to the broken down accounting equation, and we'll discuss each account category in detail. Let's begin. The accounting equation is assets equals liabilities plus equity. Now, assets has a debit balance, while liabilities plus equity has a credit balance. And under each of these classes, we can place accounts. For instance, I can place a cash and an inventory account, both debit, under assets. I can place a credit card and a bank loan under liabilities, and they are both credit accounts. And finally, under equity, I can place my revenue account and my expenses account, revenue being credit and expenses being debit. Then I will have various transactions, which will give rise to debits and credits of the same amount. And then I can assign these credits and debits to any account that I want. So for instance, here I can assign the credits to inventory and the debits to expenses. And in this case, the credits will decrease inventory and will decrease assets in general. So our assets will be minus 100. And the debits, although they will increase the expenses, they will decrease the overall equity to minus 100 because, of course, equity has a credit balance. So our accounting equation will be minus 100 equals minus 100. In practice, it can be difficult to deal with assets, liabilities, and equity directly. So we like to break them down into slightly smaller subclasses. So assets can be broken down into current assets and non-current assets. Current assets are basically assets that are fairly liquid and can be turned into cash quickly, while non-current assets are ones that cannot. For instance, a building. Liabilities can also be transformed into current liabilities and non-current liabilities. Current liabilities are ones that are due, let's say, in the next 30 days, or at most within a year. And non-current liabilities are more long-term, such as, for instance, leases, and can last over many years. Equity can be broken down into three parts. The first part is company equity, and company equity is basically an equity class that does not include revenue or expenses. And we can come back to this class later on, but for now, we can refer to it as company equity or just equity. And then the other two subclasses would be revenue and expenses. And those are fairly self-explanatory. Revenue basically are all of the accounts that track your revenue sources, and expenses are all of the accounts that track your business expense sources. And the accounting equation then becomes current assets plus non-current assets equals current liabilities plus non-current liabilities plus equity plus revenue minus expenses. And again, expenses are a debit balance on the credit side of the equation, so we have to subtract them. Now let's take a look at the actual account categories that are going to exist in each of these new subclasses that we just introduced, starting with current assets. As we just said, current assets are liquid assets that can be converted into cash inside 12 months. At Inside Hawk, we decided that this can be expressed as 6 different categories. So the first one would be cash and cash equivalents. So whenever you have cash on hand or a bank account, this is a category to use. Your inventory, if you're a retailer and say you have 2 or 3 warehouses, that would be 2 or 3 accounts created under the inventory category. Then you have your accounts receivable, money that is owed to you by your customers. You have your prepaid expenses. So let's say you prepaid an entire year worth of rent. So that will be the category to use in this case. You have your short-term investments. So any sort of financial instrument that is short-term and can be, once again, converted to cash within a few months. And then you have a catch-all category. So anything that might not be represented by the past 5 categories, you can just use other. So that wraps it up for current assets. Non-current assets are long-term assets that cannot be converted into cash very quickly. And these give rise to 5 different categories of accounts. First, you have your property, plant, and equipment. So this includes your vehicles, your buildings, and your factory equipment. Then you have your accumulated depreciation, which is a category which will keep track of the loss of value over time of each of your non-current assets. And this is mainly used to record property depreciation, vehicle depreciation. So these two categories go hand in hand, and notice that they have opposite balances, where PPE has a debit balance and accumulated depreciation has a credit balance. Then you have your intangible assets, which can be, for instance, your trademarks. You have your long-term investments, which are financial instruments that cannot be turned into cash right away. And finally, you have your catch-all other non-current assets. Your current liabilities are obligations that have to be paid in the next 12 months or less. These can be summarized into 7 different categories. Accounts payable, so this is money that your company owes to your vendors. You have your short-term loans, which is self-explanatory. You have your current portion of long-term debt, where you might have a long-term loan, but maybe the interest portion of that loan is due straight away. So you would use this category for something like that. You have your deferred revenue or unearned revenue, where maybe the customer has already prepaid you, but you have yet to deliver on the work or the product. You have your accrued expenses, where your company is accruing some expense like electricity, but the supplier has yet to send you the bill. You have your sales tax payable, which keeps track of the amount of sales tax that your company owes to the government. And finally, you have your catch-all other current liabilities. Your non-current liabilities are quite similar. These are obligations that do not have to be paid in the next 12 months. So you have 4 categories that you can use here. You have your long-term loans, you have your leases, you have your deferred taxes. So this is when maybe some of your taxes can be deferred to a future tax season and not necessarily for the incoming year. And you have your catch-all other non-current liabilities. Your company equity is all equity accounts that exclude revenue and expenses accounts. And this can be summarized into 5 categories. First, you have your owner's equity, which is used for any owner contributions. You have your stocks, which is basically the value of the equity that belongs to the shareholders. You have your dividends paid, which is basically the portion of the profit that was paid back to the shareholders in the form of dividends. And notice that dividends have a debit balance, unlike all other equity accounts which have a credit balance, meaning that dividends actually reduce the amount of equity. You have your retained earnings, which is the part of the profit which is reinvested into the business. And finally, you have your catch-all other sources of equity. Accounts in the revenue class have to do with revenue earned inside your business, and these can be summed up in 3 simple categories. First, you have your direct business revenue, or revenue earned in the main operations of your business. Then you have your other sources of revenue category, which is used for any revenue earned in secondary operations. And then you have your contra revenue category, which serves to register discounts and returns. And notice that your contra revenue is a debit category, meaning that it actually reduces your revenue, thus your equity, thus it can be in some ways thought of as an expense. Last but not least, we have expenses. which have to do with all expenses incurred by your business. And this can be summed up in 5 categories. First, you have your direct business expenses. So these are expenses that are directly part of your gross profit margin. So for instance, if you're a retailer or a reseller and you buy a product for $1 and you resell it for 2, the $1 that you bought the product for would be your direct business expense or cost of goods sold, which is another term that you will see very often in the accounting world. Then you have your operating expenses, which are basically the cost of operating your business. So this can be, for instance, rent expense or electricity expense, things like that. Now, the difference between direct business expense and operating expense can be quite subtle and really depend on the type of business that you have. Then you have your interest expenses, which is the interest that you might be paying on some loans. You have your tax expenses, which are the portion of your profit that has to be paid to the tax authorities. And you have your catch-all other expenses. Now, everything that we've seen in this video can be always consulted by going to insidehog.com/documentation/accounts. This will lead you to the public-facing documentation page that discusses accounts and the account categorization on our platform. And every category that we've seen today can be found in this table, as well as the debit or credit, primary class, or secondary class that applies, along with various examples that are applicable here. So if you feel any doubt or if you forgot anything, you can always consult all of the information on this page. Thank you very much for watching and have a great day.